Wise diversification, and realizing that safety, once taken for granted, will now need to be earned. And here is part 2, explanation, asterisk, rapid growth in the fintech sector. Consider moving portfolios into short-term bonds or inflation-protected securities if volatility rises. And remember that in today's interconnected global financial system, shiver in Treasury auctions can quickly reverberate into stocks, real estate, and your next car loan. There has been a sharply accelerated pace of issuance of treasuries, but the buyer-based foreign central banks, index funds, and pension plans has not grown proportionally. The two biggest foreign U.S. treasury holders, China and Japan, both lowered their net buying, exciting domestic factors and geopolitical tensions. This diversification reduces demand, forcing U.S. auctions to compete with other investment options that were once at the periphery. That brief stumble triggered algorithmic sell-offs in bond ETFs, sending yields spiking 20 basis points in minutes. But doing so would signal desperation, like a store marking down prices to get rid of last season's stale merchandise. Changes are underway to auction mechanics to provide a more even spread of supply across the week and thus reduce irregularities. The Treasury is exploring new retail-focused platforms that would allow small-denomination bond buying for ordinary savers and thus widen participation. Moreover, regulators are in discussions on adjustments to debt ceiling procedures to prevent the specter of last-minute political gamesmanship. Market confidence may erode, with nervous traders selling their existing bonds, which would accelerate yield rises in a vicious feedback cycle. This could lead to a stampede towards cash or gold, scarce commodities, or even digital money, as investors scramble to find safe haven. Pension funds, which rely on Treasury stability to match long-term liabilities, had to scramble to hedge in tumultuous markets,